This moves us into the next segment, is avoiding common tax surprises and using a calendar. So let's talk about surprises. Because many are unpleasant tax experience, we are avoidable with a little planning.
Right. One of the first ones is quarterly estimated taxes. That's a big one. If you have income that does not have withholding, like self-employment income or certain investment income, you may need to make quarterly payments. And if you don't do it, you can face penalties, even if you pay your full bill by April.
Right, because the IRS have safe harbor, rules that can help you avoid underpayment penalties. I mean, for example, paying at least 90% of the current year tax or 100% of the prior year tax, subject to income levels. But you have to know where you stand during the year, not after the fact. There's also safe harbor rules for couples that are married filing joint over $150,000, which require you to pay 110% of the prior year tax.
Okay, well, that's mercy. Nobody likes cutting those checks, but no, you certainly don't like to pay a penalty either. So
correct.
So another surprise we see around withdrawals from tax-deferred retirement plans. People are sometimes caught off guard when they realize that they have to pay, realize that every dollar that they take from traditional IRAs or 401ks is taxed as ordinary income. It goes down as just like income they earned, or if you will, right. I guess, ordinary income, and that required minimum distributions are the same, and it pushes their income and therefore their tax bracket higher.
Right. And this is where coordinated retirement income strategy is critical. I don't think we can stress this enough as far as the planning and the strategy comes in. We can plan the sequence of withdrawals from traditional accounts, Roth accounts, taxable investment accounts, and coordinate that with Social Security timing and charitable moves. This way you understand in advance what your tax picture, will look like.